Today, we're going to be analyzing a property recently advertised on BiggerPockets as a potential BRRRR candidate. If you don't know what that is, it is a strategy that allows you to repeatedly reinvest your initial capital when building your rental property portfolios. It stands for buy, rehab, rent, refinance, and repeat if you were successful in the previous 4 steps. So let's take a look at our property and see if we have a deal on our hands. So let's go over the property that we're going to analyze today. This property is a duplex listed for $65,000 with $1,500 a month in advertised gross rents. That certainly has a lot of potential as it meets the 2% rule, which is a general rule of thumb to help you initially filter investments. The rule of thumb is that the gross monthly income for older properties or ones in higher risk neighborhoods should exceed 2% of the purchase price. In this case, $1,500 in revenue divided by the $65,000 purchase price is about 2.3%, which meets the threshold for us to continue analyzing this opportunity. So let's create a new project to start our due diligence. As you can see, it's a duplex that's a little bit older, built in 1940. Let's click on Create Project to get started. Of course, the first thing that we want to do is to perform a comps analysis to determine the after repair value or ARV of the property. This agent is advertising an ARV of 90 to 100K, so let's validate that those are accurate numbers. I won't go into too much detail as to how to do that here. You can watch the deep dive into the subject of running comps in the comps video that we have. And just like I did there, I'm going to use an export of MLS comps from Redfin. In some areas, the Zillow API is restricted in the data that it can share. In this case, I'll have to add the basics of beds, baths, and square footage manually for this property. This is a good cross-check to do anyway for any property that you find on various sites. As for example, the BiggerPockets ad is claiming that there are 2 units of 1135 square feet, which totals 2270. On the other hand, Zillow shows 2116 square feet in its basic info area, which is also corroborated when you look at the public record. So always dig a little bit deeper when you're doing your due diligence. In this case, I'll use the public record above grade square footage at 2116. So here are our comps, and we can see that after removing the property that is leased like ours, we end up with about $91,000 for our average ARV. This is in line with what was advertised. Next, let's enter our potential rehab costs based on the pictures in the ad. For the kitchens, let's do new cabinets, new counters, and new appliances for a total of $8,000 per kitchen or $16,000 for both. In the bathrooms, we can glaze the pink tile, but otherwise they look pretty decent. So maybe a new vanity and a new toilet in each. Let's say $2,000 for each bathroom for a total of $4,000 for both units. For painting and finishing, if we paint the entire 3,000 square feet at $2 a square foot, then we can do the entire place for $6,000. For flooring, we will either put in carpet or laminate at about $3 a square foot and only over an area of 2,000 square feet for another $6,000 in costs. Generally, everything else looks good. The water heaters look like they're pretty new, let's say 5 years old. The furnace looks like it's about 10 years old. The roof looks pretty new too, and the windows look new as well. So our total rough rehab estimate is about $32,000. Which is a little bit higher than the advertised $15,000 to $25,000, but not by much. Later on, if it's still potentially a good deal, we can tighten up those numbers using the detailed rehab cost estimation tool. But for now, we're trying to make sure that this is a worthwhile opportunity. So next, let's run through our project financials by putting in our purchase, sales, and holding costs, as well as our loans, so that we can model the buy, rehab, and refinance parts of our strategy. Here, the purchase price is the current listing price, and the sales price reflects our adjusted ARV, or the price that we think we can sell it for if it was improved. If you remember, we determined this to be about $91,000 using our comps analysis. And let's say that the rehab will take us about 1 month to complete. So for purchase costs, I generally add title insurance, appraisal, inspection, and 1% of purchase price for closing costs. For sales costs, a 5% commission, 1% of sales price for closing costs, and $300 for great photographs. Given that it's an investment property, we won't be offering to pay any buyer's closing costs or even staging the property, as presumably it will be occupied when we eventually sell it. For operational expenses, we start with our annual taxes, which are $27.17 for this property. I like to keep the expense growth rate at about the same as inflation, which is about 2% right now. For property management, let's start with 10% of rented revenue. And for the rest of our utilities, the tenants will be responsible for their own metered water, cable, and electric, but we will have some electric responsibility ourselves, and of course insurance, trash, and lawn care. So let's model our buy, rehab, and refinance loans. For the purchase and 1 month's worth of improvements of the property, we'll get a hard money loan that covers the purchase and rehab costs. This is one of a few pre-calculated choices that we can pre-select from the financing section, which also includes ARV or even any custom amount. Now, because our hard money lender will only lend us up to 70% of ARV, let's see how much skin in the game we'll need to cover the amount needed for purchase and rehab costs. So to get our financing amount, if we click on ARV and add a 30% down payment, the result will be our maximum loan amount. So now, when we go back and select purchase and rehab costs, by dividing our max loan amount by the total purchase and rehab costs, what we get is that our 70% ARV loan will cover 65% of our costs, and we will need to put down the other 35% in our own cash. This is a purchase loan that will be held for 6 months while we are waiting to refinance after the 6-month FHA seasoning period. The loan is interest only at a rate of 10% with 2 points and $500 in lender fees. Now let's add our conventional refinance loan. We are going to refinance at 70% of ARV, meaning our equity remaining in the house will be 30%. We will hold this loan for 27 years, which is our depreciation period, with the loan starting at month 7 right after our seasoning period ends. The loan will be a standard 30-year amortized mortgage at a rate of 4% and no points or fees. Now let's add rental-specific property parameters. We will not be renting the place while it is being rehabbed for a month, so it will be vacant at that time. Speaking of vacancies, let's start off with a 10% overall vacancy rate, and at least in this neighborhood, a pretty low appreciation rate at 2%. The income of this property is currently advertised as a possible $750 per unit, so let's start with those numbers. There is no other income potential listed, but if you had assigned parking or laundry, for example, you could add those here. So the only thing left to enter on this page is CapEx. Many folks start off with keeping just 5 to 10% of their income for reserves, and I'll show you how inadequate and destructive to your business that can be. In order to show you that, first we'll have to enter the itemized CapEx costs. So for this property, the paint, flooring, appliances, counters, and cabinets are new because we just rehabbed them, and from the pictures it looks like the water heater, HVAC, and roof are about 5 to 10 years old. Remember that since this is a duplex, with the exception of shared systems like the roof, we will have to double everything. So going back to the top now, if we were to do what people often do, and that is hold back an arbitrary percentage of receipts for reserves, in this case, let's do 10%, we will have put away $57,000 to keep the property maintained. But if we itemize our CapEx costs based on the lifespan and replacement cost of our major systems, we should expect that we will actually spend over $132,000 for replacements. That's more than twice as much than initially planned to maintain this property throughout our holding period. Let's go to the analysis section and see what it looks like when those costs hit, and talk about our state of mind throughout our ownership period. In the first 5 years, we're doing great. Nothing is breaking down, and eventually at year 6, we get our first small hit of new paint or new cabinets, just to freshen the place. No big deal. Then we happily go on for another 4 years. No big systems need replacing, we're feeling good about our cash flow, and patting ourselves on the back for being such awesome investors. Since nothing is breaking down, we feel justified with our reserves holdback. At year 11, bam, a huge hit when everything seems to go out and we need to come up with almost $60,000. It would take 8 to 10 years of using 100% of our cash flow, a decade of working for free to recover from that kind of a hit. Now we feel like we're drowning, but maybe we survive it and use the cash flow from our other properties to help overcome our deficit. Only 5 years later, we got another small hit to the bottom line. And 5 years after that, another huge hit that would take 4 to 5 years to recover from. It's no wonder why so many people fail at rental real estate. When a property is undercapitalized through the use of arbitrary holdback amounts, instead of going the extra step of calculating expenses based on well understood costs and lifespans of a home's major systems, the most likely outcome is that the investment will sink and possibly take a few others along with it. So if we go back to the CapEx section, if we expect that our itemized CapEx will cost over $132,000 over the holding period of the property, then our reserves should be closer to 23% of the receipts if we're only collecting $750 per unit in rent. Of course, this will be different property by property depending on the produced income and the expected quality of finishings. So now, when we go back to our analysis tab, we can see that when we adequately plan our reserve expenses, no one year hits us so hard that we have to liquidate, and we can maintain a predictable cash flow. So let's do a thorough analysis of this property. In order to ensure that you have immediate equity in the deal, you might want to start off with using the 70% flipping rule to determine what your purchase price should be. Using our flipping analysis tab, you can see that when including the rehab costs required to improve the property, you would need to purchase it at around $32,000, so not looking good so far for equity at the current listing price. Going back to our rental analysis, we see that we're starting off with a negative cash flow and a negative cash-on-cash return, so not too good there either. Additionally, the project-wide internal rate of return is just above 3.3%. which is a pretty terrible use of capital. So the question is, are there any levers that we can pull to make this deal worthwhile? Well, obviously the first one is purchase price. Given that this property has been sitting for over 6 months, it is no doubt overpriced. So let's change the purchase price to $32,000. Yes, it's highly unlikely that an owner would take less than half of asking price for an on-market property. But if you wait until the listing gets canceled before you approach the seller, then the seller is much more likely to entertain your lower offer since he won't need to pay realtor fees. Reducing the purchase price changes the IRR to above 5.4%. With that change, the purchase and rehab costs are now near 70% of ARV, and so we should be able to change the financing to 100% of the project. This should eventually improve our cash on cash if we can get our cash flow into the positive. Unfortunately, changing our loan amount also has the negative effect of slightly reducing our rate of return, given that we're paying more to the bank. The next thing we can try is raising rents. Currently, both units rent at $750 each, bringing in only $1,500 a month in total. The Zillow rental estimate for a unit in this property is about $850, so let's try using that instead. 850 times 2 is $1,700. Now our internal rate of return is above 7%. When we change our income, we should also revisit our reserves holdback. Reducing our reserves to 20% of income has the effect of increasing our rate of return to above 8%. Now we're getting somewhere. The next thing we can try is to reduce our property management fees and tighten up our vacancy rates. If we lower PM fees to 7% of receipts, now we're at almost 9% IRR. And maybe vacancies are closer to 5% in that area. So again, our IRR increases to 10%. With this change, our income for the year also starts to exceed our expenses. And so finally, we end up with a positive cash-on-cash return for that first year. So, is this a good deal? Well, not exactly as advertised. In order to make this deal work, you're going to have to do three things. You're going to have to purchase it at a great discount at half of asking price. You're going to have to raise rents at least $100 per month per unit. And because the income is so low, you're going to have to keep your expenses extremely low and still maintain adequate reserves. So when you find a property that looks good on paper like this one, which exceeds the 2% rule, that's pretty rare these days, you still have to do your due diligence to make sure that the deal economics still work in your favor. And in this instance, they don't. So for this property, no deal.